Do you own the trademark? Or probably you have developed some software application or a platform for artificial intelligence, and you're planning to sell it, contribute it, or just to put in a safe place, then this video is for you. Hello, my name is Artūrs Breicis. I'm tax advisor in Latvia. We are specializing in valuations, including intangibles valuation. And in today's video, I'm going to talk about the intangible asset valuation. So, first of all, the definition, what the intangible asset is. An intangible asset is an asset that has no physical form, but that brings some value to your business and benefits for the company. The typical intangible assets are trademark, the most used intangible, software applications, patents, licenses, technologies, databases, know-how, and other similar assets. So these assets, intangible assets, could be distinguished in two categories. First of all, it's commercial assets and trade assets. So the commercial assets relates to production, to creating the product itself. It's like a production processes, improving some processes, technologies, patents, and so on. And trade intangibles are related to the movement of the goods to the customers. First of all, it includes trademarks, some know-how, clients, databases, and so on. So, in order to any of these classes or types of intangibles requires different approaches to the valuation. So that's why the analysis starts from the understanding what the intangible asset is. Of course, in practice, most of all, we come across this trademark valuation, but sometimes we do, and quite often, and it's free. In the last time we are doing many projects related to software valuation, and the most software valuation of the platforms and other IT solutions which are created for the use of the multiple users. Okay, valuation is made to determine the asset's fair value, and the fair value is the value at which knowledgeable persons are willing to exchange like money for a trademark. But the purposes of the valuation, purposes of the deals may differ. So first of all, valuation may be required to determine the license fee. So if you have some intangible asset, you may be willing to license it out to some external or related party in order to make use of this intangible. So the first is license fee. Number two is transferring or selling the asset. So if you have this asset, you may be willing to sell it or contribute into the share capital, or make a reorganization by spinning off the intangible or similar way. And last is the preparing transfer pricing documentation. So if those activities or those transactions are being carried out between related parties, then of course you have to prepare the transfer pricing documentation, and this documentation is based on the valuation principles, and sometimes using the same methods which are used for valuation of assets. Valuation subject. First of all, to make a valuation, the subject and the scope of the rights should be determined. Here are some of the recommended factors which should be considered. The list is not exhaustive. This is just like to have an idea what are being analyzed. So it's, first of all, is it a standalone asset, like one trademark or several trademarks, or it's a some combination of intangible assets? Who is the owner? What are the legal rights? What is the geographic and other scopes, useful life, and so on. The factors which affects the value are similar. So, first of all, the main factor is expected revenue. It's what is the economic benefit which this asset brings to the company, to the owner, or to the user of this intangible. Of course, what is the useful life? How long the asset could be exploited? market demand, legal protection, but there are also factors diminishing the value is that asset-related risks, how easy the asset could be kind of abused or some copied or stage of development. Of course, it influences the choice of the method and so on. So what are the value drivers for different assets? Let's start. This is the software. First of all, software includes the functionality, user base, and revenue potential. So unlike the traditional intangible, software could be created very fast, and it could bring the value also very, very fast. It doesn't require many years of exploiting in order to generate the base of users and accordingly profit. So if the software makes some solution for a problem which exists today, and it is able to make this solution today, then of course the software could create this value almost instantly and or in very short period of time. Unlike the software, trademark requires recognition, reputation, and it takes a long time to build a reputation. But the good thing about the trademark is that it impacts on pricing and demand. If you compare the similar for products, like for example some drinks or clothing, so the same quality and the same kind of ingredients, but the price and demand has a huge difference because one has this brand and then the simple product doesn't. So the trademark is very kind of useful. Technology and know-how, the same as software, requires functionality, but there are certain risks that it could be substituted and risks of replication. And each technology and know-how must have some competitive advantage in order to kind of sustain and be able to win in the market. And the next group of assets is platform, which is kind of combination of several assets to generate revenue, and it's very popular in latest years to create such platforms for users, for businesses, different businesses to use, and it brings value, often competitive advantage for digital sales, and that's why creating such platforms, sometimes based on artificial intelligence, well, not sometimes, but always based on using the artificial intelligence, are becoming more and more popular, and that's why the value of such platforms should be also assessed properly. Valuation process. So it must have several steps which we will be going through. So the first is defining the scope of the valuation, like valuation subject, purpose, and valuation date. Of course, the valuation depends not only on the type of intangible, but also on the purpose. So the purpose valuation for the tax authority should include some a little bit slightly different approach than the valuation which is made for example, contribution of share capital. Because for the contribution of share capital, we have to just prove that the value of the assets being invested are not less than showed in the papers, in legal papers. But for the tax authority, valuation should be much more advanced, more appropriate, and much more kind of proving that the fair value of this asset. So the different purposes requires different approaches. Asset analysis. So next is asset is being analyzed, the pertaining rights and economic potential of the asset. And then comes data collection, financial, market, and legal information. Based on that, we select the method, method of valuation method, and calculate value, making data analysis and applying the selected method. And at the result of this, we receive the valuation results and determination of the final value. So what are the standards? There are ISO standards, brand valuation requirements for monetary brand valuation, but also Latvian property valuation standards are being used. Then regarding valuation approaches. First of all, we have three main approaches, theoretical approaches, but they are not similarly used. I will describe why. But in theory, we have three approaches. One is market approach, cost approach, and income approach. First, market approach. Theoretically, it's a very appropriate method. The value is determined using data from transactions involving comparable assets or license agreements. So basically, we cannot find two similar transactions, so we must use some multiples. And multiple, for example, is calculated as the value of the real deal divided by the income of the royalty income for 1 year. So, for example, if you have a transaction with 1 million trademark price with 1 million and revenue stream from licensing this is 100,000, then the multiple is 10 times. So that's very kind of logical method and simple method, but unfortunately such data about such multiples are not available, at least publicly, and also that's why such approaches we are not using this in practice, and it's more like a theoretical approach. The next, cost approach. The value is determined based on the cost of creating, replacing equivalent asset, and it's suitable for early stage assets. So when you create some asset and you don't know what the revenues will be from this asset, you can use the cost approach, and by summing up all the costs of development, like employment costs, like payroll, depreciation, third-party invoices, and so on. So you accumulate this value by summing up all the relevant and attributable costs. And here, usually, development costs are attributable, and some costs which are related to some research usually are not. So this approach works only when the asset is in very kind of early stage, and we don't have sufficient information to forecast the potential revenue stream in the future. So we have one good example when we made this assessment for one client who made the development of the technology in several stages, and each stage, the end of each stage was the beginning of the next stage, and actually the sellable asset was produced only at the end of the third or even fourth stage. So what we did, we made the analysis of all the costs and summed them together in order to identify which costs are appropriate, attributable, in order to create this asset. And at the end of those three or four stages, we calculated and gave up to some value of this asset, intangible asset. So, but the most usually used is income approach, which is based on the present value of the future economic benefit generated by the asset. So basically, it's based on the future economic cash flow stream, which are discounted in order to calculate the net present value of the project of this project. And this approach is suitable when you have a revenue stream, forecasted revenue stream, which when it is obvious or it's easy calculated, could be easy calculated what the revenue in the future will be, and yes, and then you can apply this income approach, and most likely this is the most used of the all three methods. So example, let's assume that this person is an investor who is having, who has developed brands, trademarks for the clothing, several trademarks, and he's considering what to do. So the question is, what is the value of the trademarks, and what can I do with those trademarks? First of all, as we already discussed, if the trademark is kind of at the early stage, then it is more logical to sell the trademarks to put it in the company and to sell it to related to the subsidiary which is actually doing business. And let's consider that. Let's assume that this is a trade company making a trade, selling those goods like clothing. And if a person owns the trademark and he has registered this trademark and is developing it and making investments and so on, so at the early stage he or she can sell the trademark for, let's say, at cost. Like sale at cost. That's why this is important, because if the at the later stage, when the trademarks are becoming more and more worth, has more worth than before, so the person may have to pay a capital gains tax. So it is always recommendable to sell the trademarks at the early stage. So then the market value or fair value is lower, and the capital gains are lower than compared if the goods were sold later at the higher price. So at this stage, this person can sell the trademark to the trading company, and trading company may use this trademark in order to sell the goods. But then when some time passes and the trademark is becoming more and more valuable, so what comes next? There is a risk that something may happen with this company, and it is a good idea to create a separate company. Let's call it IP company, and transfer to those trademarks to this IP company. And in order to transfer these trademarks to IP company without inheriting the risks, which of this trader, the only way is to sell those trademarks to the IP company. And then at this stage, of course, if here we could use a cost approach because it was at the early stage, then at this stage, most likely this will be the income approach or discounted cash flow approach. This is because we know already that trademarks are generating the income stream, and we cannot just say, okay, we just bought it, let's say at 10,000, yes, and here we are generating millions of income, and we cannot say that we will sell at those 10,000s, but we have to find the fair value or arm's length value of this trademark. So this could be seen on this example. We have a clothing retailer, this is trading company, and we have IP holding company. And what happens here is that clothing retailer sells, here's a sale of trademark, and IP holding pays money for that, and then the holder and owner of the IP is of the trademarks is this IP holding company, which in next step is licensing back this use of the trademark. It's licensing back, and clothing retailer or this trading company is still continuing to benefit from these trademarks selling the apparel and making license fees for the license owner. Yes, this is, let's say, so-called sale and license-backed transaction. So, knowing that, what should we value? So, let's say that of course, we should also evaluate the geographical scope and purpose of the valuation, as we discussed, remaining useful life, and we come to conclusion that the remaining useful life is indefinite. The trademarks, the countries in which the goods are being sold, and so on. And we make a conclusion that we will use the income approach. Step number 1. First of all, we have to determine the projected revenue. And the projected revenue of the apparel trading who is using this trademark. Let's do the following way. Let's have 5 consecutive years and make a forecast for 5 consecutive years, and then the rest is at the terminal year. The value is kind of extrapolated to the infinity by assumption that the growth is 1% per year. So the first years we have the exact numbers of turnovers, and then it is considered that the growth is continues 1% per year to infinity. So the next step is to calculate the royalty rate in order to find what the income from the royalty would be. So for this reason we use the specific databases, because this information is not publicly available. First of all, it's royalty range or royalty stat or kitty mine. So I know free service suppliers. If you know someone else, please put in the comments. So as a result of research, we find out that the average royalty rate is 2.5%, and we will use this number. So let's put it in the table, and we have the royalty amount like this, each year by year. And after this period, we assume that the growth will continue 1% per year, and we make the assumption such and make the terminal value by applying annuity, discount factor annuity for the infinity. So discount rate is calculated to find out the net present value of the future revenue stream. So we have to calculate the discount factor, which is based on the weighted average cost of capital. So cost of equity capital and cost of debt capital. So regarding debt capital, it's very easy. So it's like a short-term interest rate. And regarding the equity capital, the calculation starts with risk-free capital, which is then adjusted by beta and other risk factors. This may, depending on the evaluator, the methodology could vary, but the idea is that the cost of equity is established and the cost of loan, and then based on the debt to equity ratio, the average cost of capital is calculated, which in this case is 12%. So we apply this discount rate, calculate discount factor, and make the discounting and calculate the amount of discounted royalty amount, which then makes altogether, summing up all of those figures, we come to the conclusion that the total trademark values is 266. The total trademark value is 266,000 euros. Applying the liquidity discount rate, adjusted trademark value in this case is 210,000 euros. So, what we can conclude from this calculation? So we conclude that if we have this structure where we have a retailer or trader, previously we called it, and here is IP company. So if the in the first step retailers should sell the sale of trademark for roughly about 200,000 euros, and then IP company should lease it back, of course if it wants to do that, if it wishes to do. If not, then it could also hold it for without licensing, but the idea is that the IP company should earn from the licensing back of this, or probably licensing this trademark also to some other traders. But in this step, let's in this situation, let's assume that the only related party is the client. So the sale of trademark is for 200,000, and licensing back is for 25,000 per first year, and then for next years. So the idea is that if you make such a transaction like sale and license back, then those transactions should be interrelated. So basically, sale should be equal to the sum of discounted values of the licensing payments. Yes, so you cannot in the first step sell the trademark for 10,000 and then license back it for 25,000 euros. So if this happens, then tax authority will ask questions why it happens. So for example, if you sell for 10,000 and then lease back for 25,000, yes, so this shouldn't work. Like sale and license, this shouldn't. Those two figures should be, those two steps should be kind of interrelated and mutually kind of supportable. Let's say in this way. So I hope that you understood the idea behind those calculations and that it brings some idea or some knowledge to you. And thank you for listening to this video, watching this video. I hope this give you some additional ideas or knowledge and so on. So thanks again, and hope to see you soon. Goodbye.